Hi, everybody. This is Lynn Sautter Beal of Upstart, and welcome to another episode of Leaders in Lending. I'm joined today by Melinda Zabritski, who is the head of Automotive Financial Insights at Experian, and Mark Pregmon, who is a VP of Consumer Lending for USAA. Thank you both for joining us today. Happy to have you here. I think Melinda and Mark, I'd love for you to just give our listeners a little bit of a brief intro about your backgrounds and kind of how you really became leaders in the lending sector.
Yeah, great. So, Melinda Zabritski, I've been with Experian going on. I actually just completed my 21st year here. And I've kind of started more in the product development area, really focused on lender oriented, data products, mostly around industry trends and what we're seeing happening in the industry. And I started putting together a regular quarterly presentation on state of the automotive finance market and have wrapped up my 72nd quarterly presentation, getting ready to start number 73. So really just focusing on what are we seeing in auto finance.
And I'm Mark Pregmon, general manager of consumer lending at USA, 30 plus years in the industry. Banking my whole career right out of college. Started with SunTrust, which is Truist Bank today. I was a buyer on the desk, buying an automobile paper, calling on car dealers, selling our products and services. But I also have experience in other asset classes like home equity, credit card, small business lending. So my whole career basically has been what I would call consumer lending, not really commercial lending. Although I have some experience in that. 90% of my experience have been lending to consumers. I think 24 years at Truist and 9 years at PNC Bank, and now here at USA for almost five.
Wow. So great. I think between the two of you, you've certainly seen a pretty significant changes in the auto industry with the rise of electric vehicles and many other shifts between domestic and international production and who's kind of winning the race at any given point. I think that interesting thing and kind of everyone's hot topic right now are the tariffs on many products, but particularly on auto imports and auto parts. And so I've actually even seen some marketing emails from dealers that are near me that I've bought cars from in the past that are saying, "Hey, it's on our lot. Come buy it. These things are tariff free for now." So certainly very disruptive to a lot of industries and a lot of change to navigate to right now. So how do you see this playing out in the near term with manufacturers and dealers? And then how do you see that kind of impacting the consumers and the affordability of those cars?
So I will start. Melinda and I did a presentation together at Consumer Banker Association and CBA Live. Is it 3 weeks ago now? Melinda, I'm losing track of time. And tariffs were the hot topic because they hadn't started yet. Um, I would say that anybody, that was the key word, key phrase we heard. If anybody can tell you they know what's going on, what's going to happen, they're lying to you. They have no idea. Although I will tell you, since Melinda and I spoke to it at the CBA Live, I have a little bit better handle on it today because things have transpired, things have happened. Um, and I see that automobile industry and the manufacturers are adapting. They're trying to figure this out as well. And we're seeing like Audis leaving their cars at the port. They're still delivering, but they're not taking delivery of them. We're seeing that car dealers are trying to push, like you got the email that they're trying to push sales now. We're seeing an increase in our application volume. And I was actually listening to sales calls at USA. They require us to call Y cording. And what we do is we listen into our service reps, whether they make a loan, sell a loan, or collect a loan. We listen to the whole life cycle to try to improve that experience for our members. And I listened to some sales calls, and I'm trying to get in before the tariffs. I heard that come through while they were taking the application. So I think we're probably pulling some demand forward. Now, how it all levels out, I don't know. But I also think, the rhetoric on the tariffs is kind of toned down a little bit with some pauses announced here lately. So who knows what's going to happen? But I don't think it's going to be as negative as it was when Melinda and I were talking about this 3 weeks ago. So on manufacturers and the dealers, well, they're adaptive. I mean, if anybody knows how to adapt, it's going to be car dealers. Linda, I don't know your take, but we're seeing increased demand.
Yeah, I actually just wrapped up last week two additional conferences, and definitely this is the topic that everyone's talking about. I saw some presentations from some economists that were trying to estimate what they expect the SARs to be, and they were definitely reduced from what I had seen previously. Anticipation of potentially reduced manufacturing profit. So, that's something that I think that is still kind of up in the air. I think everyone pretty much agrees though that, there will be an impact to affordability around, loan amounts and, they're already extremely high. So we can anticipate that going higher. And then, of course, there's the anticipation of as prices increase on new and very likely hit record peaks, shifting more consumers into used vehicles, which are already at a little bit more of a tight supply, and that causing even perhaps more of a ramp up demand for used and potentially increasing those used values as well.
Sure, and that's actually a topic that kinda hits near and dear to my heart. I have 3 kids, and, 2 of them are drivers and out of the house, and 1, is about to be a driver within the next year or so. I will be in the market for a car, and my middle one, was kind of, in need of a car right about the last spike in the used, vehicle market, during COVID, so, probably gonna get hit twice, twice by similar economic factors. With the vehicle prices, kind of still elevated even on new cars and used cars and potentially increasing on used cars with lower supply. Do you see lenders sort of adapting loan term structures to address that affordability?
Yeah, I would say from a lender perspective, you're seeing it across the market. Um, it, it hasn't changed drastically because I still think the consumers they may see that 72 month or the 84 month rate out there, but they're looking at the rate they have to pay. It really just comes down to a payment. I think that's they're trying to back into a payment, but we are seeing. I think that Belinda, you said I think it was like 20% of the market, 20+% is now 73 months or greater. But the interesting thing, the average term on the books for a lender like ourselves is 68 months. So it still hasn't changed that much. Maybe it got up like from 66 to 68, but it hasn't changed that much. So I think that there are, and I think that we're seeing that focus out there, but a lot of the consumers just aren't taking those longer terms. So
Yeah, and the majority of financing really is 72 months and above, with mostly right at 72. And yeah, those averages, right around the 68 months. I think some of the things that we're seeing on this is if you think about it, term really is the only thing left to adjust to bring the payment down. If rates don't come down, loan amounts are going to be going up. Term is really the only thing to pull. But then again, how far out will lenders go? I mean, there are lenders out there that do specialize in things like 97 plus, so you do see that. Then, of course, there are much more conservative lenders that don't do that. But I think ultimately, yeah, is term going to get even longer? Who knows? What happens if we increase the loan amount by $4 or $5,000, without pushing term out? That has a considerable impact on that monthly payment. I mean, new car payments right now, we're already starting to see so far in Q1, like around 750 a month. And add a couple grand on that, you're in the 900 range. And I mean, we already do see, 15, 16% of new car payments are over $1,000. And that doesn't mean it's a, luxury vehicle. It just means it's a $40,000 vehicle at 8% rate for, 60 or 72 months.
yeah, and I'll put some perspective on that too, because been in this business, like I said, 30+ years. When I was a buying paper from car dealers on the desk, we were moving from 48 to 60 months, and we thought the world was going to come to an end. I mean, we really did. We're like, oh my gosh, the sky's gonna, and it didn't. Okay. And I think consumers adapt and they're smart. But I also think too is that cars are lasting longer today than they were back then when I first got into the business. Like, cars you really had to worry about, was this going to go 100,000, 200,000 miles, right? And today with the quality of the cars being manufactured, that's not an issue like it was before. The term had a lot to do with the useful life, right? And so today it's with cars lasting longer and consumers driving them longer, right? That term I don't think is as big as it was before because it still has useful life.
Sure. That's an interesting point. Yeah, I think that's you can certainly see plenty of cars on the road that have been around for a long time. You maybe wonder a little bit how they're still running, and whenever you hear a noise with your own car, you're like, that one's out here, so I'm sure mine is fine." What with the other changes in kind of the macroeconomic environment over the past year or so, rising inflation, higher home prices, sustained higher interest rates, not and interest rate cuts not being as deep as maybe we would have forecast by this point. Are you seeing any notable changes in delinquency rates, or even just kind of people who are slower to pay, or changes in auto pay where people may have been much more confident in their cash flows in the past.
I'll let
Yeah.
you answer that. That was a topic of discussion a couple weeks ago, and then I'll answer it from our
Mhm.
perspective as well. So Lynn, why don't you just maybe talk to the general market?
Sure.
Yeah, absolutely. So over the last couple years, yes, we have definitely seen delinquencies increase. The majority thing that we tend to track is going to be 60-day delinquency rates, and they certainly are increasing. From a 60-day rate, we're very similar to the peak that we had back in 2009. I think some of the big differences we're seeing, of course, are used values are still strong. So if you are repoing and take selling that car to the auction, sometimes the deficiency balance is a little bit better. The area that I think we're seeing that it has get more focus on it has been some of the increased delinquency more in the near prime space. Credit scores 600 to 660. Those delinquencies are increasing at a bit of a faster pace. But at the same time, the increase in delinquency went hand in hand when all of a sudden, used values jumped up 40%. New car prices, increased 30, 40%. And those payments went from $400 to, like I said, 700. And that definitely has had a result in those rising delinquencies.
Yeah, and I would agree. And tracking the industry, that you've seen a rise across all credit spectrums, whether it's prime, super prime. Super prime really hasn't gone up that much, but it's been more in the near prime, and the subprime is where that. And so those are all up, and also repossession rates are up too as well. We're seeing that as well. But for us, we're a little unique. You say we are up, but we are not even close to the industry. We're still tracking better than the industry. A lot of it has to do with our membership. Is that about 50, a little bit over 50% of our members that get a loan from us have a government paycheck. So they're active duty, they're retired, and it's a lot of them are dual income. So that I did my 20 years in the service, I retired to get my military paycheck coming in, and I'm also reservist, but I'm also working on the local police department as well. So we got a little bit of that, a little more employment stability. So I kind of expect that out of our book and how it performs.
That I think that's a good point about especially the potential, like, retire after, 20, 25 years of service, and you're still, working and of working age to take on kind of a second career in the private sector. Um, uh, as you think about then, cars becoming more expensive and potentially more delinquencies, are you seeing, I know we're seeing in the data an increase in auto interest in auto refi, and refine those loans, maybe not necessarily for a better rate, but to extend that term, lower the payment, kind of re-amortize it again. Are you seeing that as well in the information you're reviewing?
Yeah, so we actually have an increased loan demand on that. I think the refi wave has got delayed a little bit, and just my experience, in my opinion, because rates aren't measurably down. I mean, they're down. Your average car rate's down that more than it was last year, but it's not meaningful enough, because I still think the consumer is looking at my cash flow, my what's my monthly payment, right? And so I don't think it's that advantageous for them now. Is $50 big? For some consumers it is, for some consumers it's not, right? So I think there's a little bit of that. But we have seen a pickup in, matter of fact, when I talked about that Y cording, I listened to 5 calls, and 2 of those calls were refinances from another institution, and we had a better rate, and it was a meaningful difference for them. And we didn't advertise that. They just on their own volition came to us. So I think it's in their minds. And so I just don't, I think the wave is kind of pushed off, because we're expecting more rate decreases this year. Now it's 2. Now it could be more if we go into recession, who knows? I don't, I know it's on their minds just because of inflation and cash flow and stuff like that. So Melinda, I don't know what you're seeing.
Yeah, actually, we joked about this at CBA because I got my USAA auto loan refi offer not too far in advance of CBA being a USAA member myself. But we do track and
Thank you for your
we do have
membership, by the way.
you are very welcome. But we do track and look at what we're seeing happening in refi. And yes, there's definitely refi occurring. It's not nearly as much as what it was when rates were really low, in 2020 and 2021. But in what we're seeing, as what you just mentioned, is a consumer who maybe booked a 72-month loan or a 65 on average, and then 18, 19, 20 months into the loan, they're now refinancing again. So going from a 72-month loan to a 65, but after already paying 18 months. And we are seeing in general about a $66 payment savings. Absolutely it will have that consumer paying more over the overall life of the loan. But again, if it's dropping that payment 60 to $70 and they're able to stay current on that loan, that's definitely a good thing. But obviously, yes, they're going to pay more over the overall life of the loan. But if rates come down, we do expect refi to pick up a lot more.
And we do a lot of education to our members on when is the right time for you, because you're right. If you're 12 months in and you did a 60-month loan and you do another 60-month loan and refinance, you're essentially getting a 72-month, right? And so you got to look at the total cost. So we try to educate them. But I will tell you that a lot of, just in general, consumers are a lot of just managing their household cash flow. And we still got inflation we're dealing with, and then who knows, like we talked about tariffs, what the impact might be on other consumer goods out there, right? That may happen. So I think it's on their minds, and we're seeing an uptick on it. Not the wave that we thought it was going to be, though.
Sure, but maybe just more consumers instead of, like, people being more advantageous about rates because there's not as much, margin there, people who need the free cash flow and maybe are paying a little more long term, but are making their day to day, month to month more affordable
Mhm.
if they're a little more
Yeah, and
constrained.
I also think too, it's a little bit of an I don't know, like an ego thing is the right word, but how people compare your FICO score. I was playing a golf match a couple weeks ago. My buddy goes, "I know you're paying. What's your FICO score?" He goes, "Is mine higher than yours?" Right? And I think people go, "What'd you get on your car?" Well, I got 9%. Well, I got 7. Then you feel like, oh, I got to go out and get 7 now. You know what I mean? So I think it's one of those things. It's just like, but I really think it's going to come down to, is it worth their time and effort to refinance, and is it going to make a difference? I think anything over $50 can be meaningful for a lot of consumers.
Mhm,
Yeah,
mhm. Okay,
absolutely. It's funny
awesome.
you were talking about the score comparisons. Totally as an aside, at one of the conferences last week at the evening reception, was hanging out with a couple clients and or just industry folks, and they said the same thing. They sit there and compare their scores, and they both whipped out the Experian app and were like, see, this is my score. Mine's better than yours."
Yeah.
That is funny. It is everything's a little bit gamified, today, so, well, I know, like, obviously, there's a lot more. I mean, there's a pretty solid trend for a while of people buying SUVs and bigger SUVs, and even though they continue to go up in price and many of them hit the $100,000 mark and more, um, what are you seeing on, kind of trends in car buying behavior now over the past year and into 2025, particularly around like SUVs and then electric vehicles, which I know, depending on the manufacturer, have grown at different rates. Like, frankly, I had an Audi EV for a few years and traded it in on a kind of went the opposite way. It went to a full size Ford Bronco from an EV after a few years. I could see using an EV in the future too, but really needed the SUV space at the time. So just are you seeing that any trends in buying behavior there?
It's definitely an SUV market. When we look at the kind of vehicles, especially on new cars, well, used cars too, that consumers are purchasing, the majority of the market's is SUV. Over 60% of new vehicles are SUVs. And it's not necessarily the luxury. The biggest volume are really the non-luxury SUVs. It's the CRV, it's the RAV4, it's the Hyundais. So it's really, that non-luxury kind of small to mid-size SUV that really dominates what drives the market. And of course, as new cars really switched over to SUVs a handful of years ago, that's what the used cars are too. Of course, on the used side, you've got a lot of the F-150s, so it's a lot of pickups and then those SUVs. It's interesting on the EV front though, because just as Mark was mentioning, kind of a ramp up of people rushing to the dealers to get the car pre-tariff. Kind of the same thing I believe is happening in the EV space about potentially losing the tax credit and the subsidies, because we saw so far in Q1, EVs are almost 10% of new car purchases, and we ended last year lower than that, like 8 to 9%. So we've definitely seen a ramp up, and what was most notable was, last is leasing on EV. Um, last year we ended, around 48% of EVs were leased. We're almost at 60% right now for Q1. So I think there is that rush of people who are in the market for an EV or interested in getting an EV and getting it while they can still take advantage of that lease credit.
Yeah, I would say that's a good point. I also think, getting back a little bit to tariffs, I actually think EVs will be impacted more because just because of tariffs in general, right? And because where the parts are manufactured, but the prices will go even higher because the incentives are going away from the federal government, right? So I think the price shock will be higher in the EV. So who's to see what's going to happen there? But because I think it's going to hit EVs harder. On the SUV, we track just like everybody else. The number one truck finance F-150. That's our number one financed. We're seeing that. I think that you see manufacturers are dropping cars now. Passenger cars are they're going SUVs and trucks and stuff. I think the same thing I just talked about with the term and cars lasting longer. Those SUVs have gotten more economical because they're getting better gas mileage today. I remember back in the 2000, early 2000s, we had that recession when the government was asking incentives to buy cars, right? They were pushing, and the SUV sales went like that. Yeah, remember that? Crash for clunkers. And then SUV sales, well, I mean, dropped off the cliff because gas prices were like double. And then all of a sudden, gas prices went down and the SUVs went, I mean, it was like, didn't you learn your lesson? It's like you're still gonna have that issue, but I think so. I don't think it's as susceptible to gas prices like it was before. And yeah, but yes, they are expensive. And so, but I think also too, those passenger cars, like those luxury cars, they're dropping their entry levels now because they just want you're going to get the fully loaded and the top of the line, and so it's a little bit of give and take on that. But we are seeing that more on the SUV just because it's I think it gives it more if you get a growing family, those type of things.
And once you get used to driving an SUV, it's very hard to go back to a sedan, I have found. So I've tried to do it now twice over the past probably 20 years where I had a SUV for a period, tried sedan. I made it I think the longest was my EV, my Audi EV, which made it about 2 years, but I also work from home, so I don't drive it a
Yeah.
lot.
Mhm.
And we also had an SUV during that period that was my husband's. So
Uh, no, and I'm the
uh,
same way. I went from a large SUV, I had an Expedition, and
uh-huh.
I wasn't worried about gas much for me. My choice, it was just too big
Yeah,
because kids were gone and they're on their own now. So I went to a Ford Bronco. It's
mhm,
smaller, but it's still an SUV, right? I wanted the space.
absolutely.
Yeah.
I stick with my mid-size
So
Hyundai Tucson because it fits in my garage.
oh, cause yeah, I know. I will say my Bronco takes up a lot of space in the garage.
Yeah.
So I have a pretty tall big one, and it fills fills the space out there.
Mm.
Uh,
One
but
one thing I do wanna bring up if I
okay.
can, so when we
Mhm.
start talking about how so much of the market has moved to SUVs, that does have the definite spillover impact into the used car market because one of the other trends we're seeing that kinda ties to the affordability and, the overall economics in the industry is because more of the used inventory are SUVs, it is pushing more consumers into older vehicles too, in order to get to a more affordable payment. So, like 9, 10 plus year old vehicles, we're definitely seeing an increased demand for that.
And that used to be luxury, right? You see that more in luxury or somebody that got a nice antique Mercedes or something like that. That's not the case today. It's just it's affordability. And I'm gonna try to get an SUV and I have to go that back far in year to get to fill my needs.
Sure. And then, and switching back to like electric vehicles for a minute, you'd both mentioned the longevity of the cars last longer, so potentially longer terms could be in the horizon. But still, I think some concern with the EVs on battery life and then what that means and the cost of replacing those batteries if they die on the car. So you've got less maintenance and regular maintenance, but that's a pretty big potential risk to your electric vehicle. What unique challenges do you see in auto financing around things like residual values and the charging infrastructure and lending for an electric vehicle?
Well, no, yes, we don't lease, but I do know that is a concern. I think it's keeping a lot of buyers out of the market on EV about, hey, I got to put in 4,000, $5,000 charging it into my garage right on top of that. Or I got to take it to the grocery store and charge it up while I'm getting groceries. I won't get a full charge, those type of things. So most of I just tell you my experience, my circle closer, it's their third car. It's not their primary car, or they're an urban dweller and they live in a city where they have other modes of transportation to get to the airport, or that kind of thing. Or they, but it's I just I it's, so I think that's still there. And think about we talked about this where at the CBA conference was a lot of those buyers too. They're on the sidelines. I live in an apartment complex and there's nowhere to charge it, right? So it's just that. So I think that once the infrastructure comes together, and I think it will naturally take over. Just like we went from horse and buggy to a combustible engine, the government didn't mandate you had to get off the horse and buggy to a car, right? And I think that if the market force is right, supply and demand, the right things come together, like infrastructure, longer charging, I think then demand will start to pick up. Price points will come into play. I think once that starts to get worked out, the market forces will work, and I think we'll get some type of equilibrium there.
Yeah. And the point around residuals, there's a lot of questions around that with, price drops that occurred among several of the manufacturers and what will that used car value be when it comes back? And I think that's also why we do see so much leasing. I mean, like I said, when I'm looking at the EV space right now, it's almost 60% leased, loans on only a third, and the rest of it's cash. So, I think leasing definitely has that comfort level from a consumer standpoint in knowing that, hey, your lease is up 24 months from now, 36 months from now, you can, go and return it and go back into another vehicle. So I think there is definitely that comfort level. And one of the comments that has come up over the last several conferences I've been at, especially around EV, is, no single vehicle, whether it's an ICE, an SUV, a sedan, a convertible, EV, no single vehicle will be perfect for everybody, nor will it meet, 100% of your driving needs. So you find the one that fits the most. And to Mark's point, frequently it's a second vehicle.
Mhm, mhm.
I
Yeah,
agree, and
I think
I think the lease is attractive just because of it's a payment issue, but I also think too, when we actually go and talk to our members and ask them about their car buying experience, what they did and what they end up doing, a lot of them are I choose the lease because I'm not sure if I wanna live with an EV for for 5 years. I'll do it for 2, see that I can make it work, so I think that's a big part of the leasing, that Melinda, 60% plus of the market's leasing for EV. I think it's like, I'm not committed, right? It's like I'm kinda partially dating, right, kind of a thing, and I'll keep my options open, so
yeah, I made it 2.5 years, and I do believe I'll own an EV again. I liked it, but again, I'm that person. I live in the suburbs. I have a garage. I have the charger in my garage, so I could plug it in when I was home. If I go into our office, the garage in our office has a row of chargers. I can charge at either place, and definitely more of a challenge. I think the road trips and the infrastructure to get from here to there and to not have to sit and wait is certainly a potential obstacle. And we were kind of that bucket too, where it was my car, but we had a large SUV that we could also drive. That was more of our primary family car. But I am really hoping that the infrastructure improves because I would love to have another one. And in the middle of winter in Ohio, it's really nice to never have to go to a gas station.
yes, it is, I
So
would agree. And Lynn, I would add too, I think for the consumers are, but they're not there yet, a true plug-in hybrid. I
mhm.
think which gave me the option. I can go 100% electric, or I can do that long trip to see my family in 2 states over and not have to worry about it. And it's great because I'm all electric and I'm going back and forth to work on my daily chores. But when I want that long, I want that true plug. But I mean, the longest hybrid now is going like what, 40 miles on electric and then has to go over to gas. And so if that gets out to the 200, 300 on a true hybrid plug-in, I think that would generate demand. I really do.
Mhm. Mhm. No, I think that would be a great, new option to have. So, as you think about then, we talked a little bit about the tariffs and, supply and demand and what that may look like for both new and used cars with rates. Um, so, coming in during COVID, certainly a lot of supply chain disruptions across every industry, and the price of used cars spiked through the roof. Um, you know, Inventory levels aren't necessarily fully back to normal. And then, your comment, I think Mark was interesting about, Audi leaving cars at the port in Maryland and not even moving them to dealerships because don't have buyers at the moment. But how are you seeing that play out with just the inventory? Any supply chain disruptions you're seeing because of the tariffs or related to other events going on globally?
I think it's too soon on a supply chain disruption. I heard um, a couple of the auto analysts out there, on some of the business updates. It's going to be 6 months until we start feeling the impact. I think it's longer than I thought it was. 4 to 6 months depends on the brand and the make. 4 to 6 months depends on where they're getting their parts from. Um, but I think it's gonna be 6 months. Hopefully, we'll get this stuff wrapped up before then, so it doesn't become an issue. That's what I'm hoping. I
And
think there
overall for the
will,
market still.
yeah, and I think there will be some short term things, not as I don't think it'll be as deep as we thought it was going to be. But if we blow through that 6 months, that's when I think we'll start to see it could curb demand and pricing.
Yeah. All right. Well, I definitely appreciate you having it on. I think one last question that I'd like to pose to each of you to kind of close this out today. forward looking, obviously a lot of uncertainty, a lot of variability, things that are cropping up in every area that maybe wasn't on the bingo card for 2025. But I'd like each of your perspectives on and what you see as maybe the top market or regulatory shifts on the horizon that banks and lenders should really be thinking about and tracking as they plan their auto finance strategies for 2025, or really for the rest of 2025 since we're a quarter in already.
Yeah, I'll let you go, Melinda.
Yeah, I think right now, like we said earlier, there's so much uncertainty that I don't think we can anticipate or really know what we can expect to see. I think people are just, and Mark, you can certainly speak better to this, but I think lenders are just kind of putting more of the guardrails around keeping an eye on, what are the latest data trends? What's the latest information you're hearing from dealers? What's the latest data points that we're getting from the variety of data sources? But everyone, I think, wishes they had that crystal ball, but things are changing so quickly and the forecasts are changing so quickly that I think there's just really still a lot of uncertainty as to exactly what we're going to be seeing this year.
Yeah, I'm less worried about regulatory and governmental now with the administration we have. I mean, there are things I think are rolling back, so I'm less worried about that. I'm more worried about the macro environment. I mean, it's just the uncertainty there. I think that's more and what the impact is. So we are putting together a playbook. So if this were to happen, what's to happen? What are the canary in the coal mine kind of metrics we want to monitor? Like when we start seeing even before they walk into the dealership, is the research for what's my car worth? What's the new car going to cost me? Is that going down? Right? Or is it going up? Is it staying flat? Before they hit the dealership, we're talking to dealers, staying close to them, even though we're a direct lender. What goes on there is really important. They're part of our ecosystem, and we're just trying. And then the health of that consumers that go through there and they're making their payments. And so we've ready to. I tell lenders, if our advice is make sure that you have the best experience, because the best, and then if, through the whole life cycle, through making a loan, servicing a loan, make it easy to change their due date, make it easy to change their payment amount, whatever they want to change things. And then when you have to collect them, when you have to make it easy to get a hold of you so you can make arrangements to get them through that time. I'm more focused on that than I and that but I can't, it's like what's going to happen. I'm more about macro than I am about the internal stuff. We're just trying to prepare ourselves for what's going to happen and have scenarios for each one, however it may play out. And I think it's gonna be a combination of all those things. I don't think it's gonna be any one silver bullet.
Yeah, control the things you can control,
Absolutely.
and worry about those.
If you provide a great, I mean, it's like I've always told you when I used to run collections, and I used to tell we want them to think of us to repay us. You got to make it
Mhm,
easy and not make them feel embarrassed because it's a normal event. Those things happen. They'll pay you before the one that does the harder technique, right? I mean, we're all like they'll work with me. I'm willing to work with you. That if you get that across, so prepare yourselves. Those things you can control.
mhm, mm, great.
Customer experience.
Well,
Yes.
definitely thank you. Appreciate both of you, for joining us today on the podcast.
Thank you, Lynn.
Thank you.
Thank you, Melinda.